Personal finance applications and how we can utilize those in our everyday life. First, we should understand that investing personally considers required rates of returns, inflations, and rates of increase over time. For instance, if you invest in a stock market and the rate of inflation is 3% a year, then you would hope if you hold your money in a stock for a year, you would at least get 3 to 4% return to break even. Otherwise, you've essentially just put your money in something and lost 3% over that time because your buying power has decreased. You also should consider tuition rates. If tuition is rising at a rate of 3 to 4% a year, but inflation is rising at a rate of 0.5% a year, then you need to add inflation onto that tuition increase so that you can find a viable solution and rate of return for you to invest your money and get money back that will benefit you in the future for what you're trying to do with your goals. And you know, if you're looking at a college fund or something like that, then you have to consider calculating the EAR, or the estimated annual return. Okay, that's essentially done by taking your required rate of return, giving it over a number of years, adding 1 to it, and then multiplying it by its power. So for instance, if you want to, and then subtracting 1. So for instance, if you want to find what an EAR is of a 5% compounded monthly, then essentially you would have to the 12th power 1 plus whatever your interest rate is, raise that to the x or the nth power, and then you would find your solution in that box, subtract 1 from it, and then convert that to a percentage, and you've got the true rate of interest that you're actually paying on a product or something like that. And it works if you're compounding continuously, and if you're compounding semi-annually, quarterly. However you're compounding, you can calculate it based on a given formula, which is essentially 1 plus the required rate of return, or the risk rate, times the nth power, or the time or the number of years over a given time, or the compounding period. So if it's compounding once a year, then you really can just raise it to the power. If it's compounding every 300, if it's compounding continuously and you're wanting to do it for 6 months, then you would have to take 180 divided by 360 and then raise it to that power. And eventually you will start learning over time, and I'll get more deeper into this, but you'll start learning that as you consider this, you will start seeing your money and your buying power stay relatively strong as time progresses into the future. Now, next we should talk about retirement accounts. What are they? What should we know? And I have a slide on the next one that'll kind of give you a little more in depth on the rules, but I'm just going to summarize them right now. Roth IRA, a Roth IRA is a tax-free account. Basically, you can invest money into it and you have to pay taxes on that money, but when you pull it out, it's tax-free. Roth IRAs are very good for people that know that their earning potential is going to be high in retirement. So while they're making small amounts of money, it's their best bet to deposit and pay the taxes at a lower rate. Traditional IRAs, they aren't tax-free, they're tax-deferred. So when you want to pull the money out, you are going to have to pay taxes. However, it's beneficial to those who in retirement or close to it are going to essentially be making less than what they make now, or they're going to use provisions to sign off all of their assets to their heirs and make themselves destitute on papers. That's a story for another day. 529 accounts, basically those are education accounts, and when a parent sets one up, it essentially is an asset for the parent, and it's tax-free money as long as they put the money into school expenses. Now there is a limitation of 14,000 because it falls under the gift tax. So you can only put 14,000 or 28,000, I think, if you're a married couple in there. A 401k is a retirement account. Basically, it's matched by employers. Most of y'all probably know what those are. They do have penalties for early withdrawal, usually a 10% penalty. Solo 401ks, however, are for business owners, and you can essentially deposit almost as much as you want, up to 40, 50,000 a year usually, and you can even match it with your business. So if you take a salary, you can pay the solo one. You could have a solo 401k or even a 401k that you put in it and match with your employer using this type of system. 403bs, those are usually for school teachers, public officials. When you get a retirement and you work for a state or something and not a private company, usually they have 403b plans. SEP IRA. This is a retirement account for business owners. It'll help you maximize returns, honestly, because you can actually put up to 25% of your business income into the account and get it tax deferred because it's not considered earned income, which is a very good benefit to business owners who make substantial amounts of money. So here's some of the limitations on the Roth SEP and the traditional IRA income limits. As you can tell, essentially, if you make anything over 196,000, that's 25%. That's 49,000 is 29%. So anything over that, you really can't deduct or put into an account for yourself, but you can do a solo 401k with some of the remaining balance. As you can tell, the SEP IRA for business owners has the maximum allotted contributions, and even after 50, you can still contribute up to 25,000 a year. It's deductible year over year, the traditional and the SEP, and when you withdraw, though, there is no tax benefit, so you do have to pay taxes at the time of withdrawal, whenever that is. As you can tell, this is an Excel sheet I created, just kind of showing returns if you were to get 7-8% returns on each account: IRAs, traditional IRAs, SEP IRAs, Roth IRAs. And if you look on the green line, the Roth, you would essentially have, after 30 years, almost $250,000 roughly. Same in the traditional. In the traditional, you would have about 200,000, and that's at 7%. However, if you go over here and look at the SEP IRA, you go down and you can see that you get almost 2.5 million. So that's for everyone to decide. It's your decision. It's what your risk tolerance is. But those are some ideas for you.